Most traders get their stop loss hit before watching the move go to their take profit without them because they fail at understanding liquidity. If you can master and spot liquidity early, you'll be able to enter the trade right before smart money does and make trades like this. To get the best entries, you must understand liquidity. So what is liquidity? Most trader influencers, they make liquidity seem so complicated. So I'm going to break it down in simple terms so that by the end of this video, you'll understand exactly what liquidity is, where to find it, and how to actually use it to your advantage. You see, liquidity basically means how easy it is to buy or sell something in the market. Institutional traders sometimes push the price lower before buying to get in at a better price. By selling first or showing selling pressure, they can make the market look weaker, causing other traders to panic or sell. This increases supply and lowers the price. Once price is cheap, they then buy large amounts at a discount. It's basically a way to reduce their costs when entering into a bigger position. So often below lows, you'll have both stop losses from long traders, which will become sell orders, and limit buy orders from institutions and limit buy order traders. This creates a large pool of liquidity, which is why price often dips into those areas because it allows big players to fill their positions efficiently before continuing in the overall direction of the markets. You see, the first thing we need to do on your chart to understand where liquidity is to define market structure. What I mean by this is define your higher time frame trend, where the highs and the lows are on the higher time frame, because if you don't have a higher time frame structure understanding, your lower time frame is often not going to play out. Think of it in this order: 4-hour chart, highs and lows, trend, liquidity. If you map it out in that order, then this is what you get. Let's jump to a live chart. I'm going to be covering the SP 500 or ES, most commonly traded, but this works across the board. Doesn't matter if you're trading Forex, gold, indices, commodities, it's all the same thing. Some assets will respect liquidity in this format more than others, but the same definitions around structure and liquidity still apply. So in the last 2 months on SP 500, we've seen both examples. We've seen both a bullish market, and since around the 29th of October 2025, we've seen a bear market. Now we can understand a shift in market structure and understand where the liquidity is in both the bullish move and the bearish move. You see this on a 4-hour time frame, you're going to see liquidity resting below lows, which in a bull market is where traders' stop losses and unfulfilled institutional buy orders are resting. So you can see here this aggressive sell-off, which was actually when China announced the 100% tariff on the US. Why did price not completely fall out of the sky? Why did it completely turn around? It's because this was a collection of orders resting below these lows in September. Price came back around again after engineering a low and did the same thing again on a smaller scale. It collected more orders. It did not break these lows. It went on to create new highs, and on a lower time frame, you will see the same thing happen here, only for price to go on and break structure to the upside following the overall higher time frame trend, which is bullish. Now we have the same thing when price shifted bearish. We see the highest point and the highest low. When price starts to create lower lows and lower highs, we have a shift in market structure. And then every time we take a 4-hour high, price pushes lower, price comes back again to take more liquidity and it drives lower. We have another example here before the latest break of structure to the downside here. And so far, we're contained inside this most recent bearish range where liquidity is being engineered. So once you have your higher time frame structure and understanding of where the highs and lows are in terms of liquidity, you also have the trend. That's when you can drop down to a lower time frame to look for entries, which I'd recommend going from the 4-hour for structure down to the 15-minute for entry. So if we go to a 15-minute and move over to the left where we saw our areas of liquidity on a 4-hour chart, what we're waiting for is time frame alignment, and the same thing in terms of liquidity. If we are looking for buys, we want to make sure that the 15-minute has had a market structure shift to the upside. So we mark out the most recent lower high and lower low. We wait for price to print a higher high and a higher low. It's done that 3 times. 1, 2, 3. Next level is liquidity. So all we do is we wait for price to sweep a low, ideally inside the New York trading session, which we have right here. we place our position on the first 15-minute retrace candle after liquidity is swept inside kill zone, and we can target a fixed 2 or 3 to 1 risk to reward ratio, which you can see plays out nicely. Your targets are going to be defined by the next area of liquidity, which in a bullish market, if we're buying, is going to be buy-side liquidity. It's going to be structural highs. We can see here we have internal 4-hour highs, and in this case, we managed to get a 3 to 1 at that structural high level. Price continued anyway, but this would have been a safe get out zone if you were not fixating on the perfect 3 to 1. If you are 2.95 RR in a running position, close the trade. You do not need that extra 0.5%, right? Same thing happens again when price comes back again into this area of liquidity. What are we waiting for? We're waiting for time frame to align. Instead of taking a risky entry on the sweep, which you can do, but for now, we want to wait for higher highs, higher lows. We have those price dips again, but respects this area of Asia lows, creates a new high. So we have 4-hour structure, we have 15-minute structure, we have liquidity, we have trend. Now for entry again, we're looking for liquidity. So inside of here, let me just replay this, go back. If we get a deep run on liquidity on the 15-minute chart before New York, we cannot expect the same 15-minute liquidity again inside New York. We're going to have more momentum and more volume. So we drop down to a 5-minute time frame just to look for the sweep. That's it. We're not looking for anything different. We can see a low, a higher high. Price comes back to the low. Inside the New York trading session, we have a 5-minute retrace candle, stops below the low, and our take profit around a 3 to 1 risk to reward, or at the nearest 4-hour area of liquidity, which is the structural high, which also happens to be the all-time high. Let's play this forward and we can see if the trade plays out. Like so. Let's go over the bearish examples. So we'll come back out to the 4-hour chart. We want to wait for the market structure shift to the downside, and we're waiting for these areas of liquidity. So we have this zone here, we have this zone here, and again inside of here, and one more here. So drop down to the 15-minute time frame. We already have structure in terms of trend, highs or lows, 4-hour liquidity. We now want the same thing on the 15-minute chart, time frame alignment, liquidity structure, ideally timing. Timing isn't always perfect. 95% of the time or more, I would trade SB 500 or ES during New York session only. Whereas last week was the first time in about 4 months that I took a London position. It really depends on market structure because that's going to define your quality of trade. So we can see here clearly we are creating lower lows and lower highs both on the 4-hour and on the 15-minute chart. If price very late into New York drives into an area of liquidity, which we had right here, we can take this retrace candle right here, the first bearish candle, which is what I call a retrace candle, after sweeping that 4-hour high, put your stop somewhere safe. I mean, 15-point stop on SB 500 is absolutely ideal. Can you get a 3 to 1? Absolutely, more than certainly you can. If you're trading futures, you might have had to cut this short at 2 to 1. The overall next 4-hour level of liquidity is the lows of Asia that day. However, we don't necessarily need to be holding for a 6 to 1. When a 3 to 1, do that once or twice a week, you're absolutely laughing. Even if you take 2 or 3 losses a week as well, you're always going to win more than you lose in terms of return on investment. So once price breaks this 4-hour low, we see price continues shortly, but then comes back for 4-hour liquidity, which we already predetermined. Now, this time, the sweep of liquidity occurs during the Asia session when most of us are asleep. There are some Asia session traders. I'd recommend you focus on gold if you're trading Asia session and not US stock. So we can see here price is driving lower, but with very little conviction. And then price breaks above this high, which swept, invalidating the trade idea. Quite simply, if the 4-hour price that swept gets violated, it invalidates the trade idea. But price ends up pushing higher in this region. There is no new 4-hour liquidity to be swept, so we simply wait for a 15-minute market structure shift before we start selling again, which we get inside of here. So the highest point to the highest low, we're now printing lower lows and lower highs, lower lows, lower highs. We consolidate inside of here until we break lower, and then bears are in control. Here we have a 4-hour high engineered, because inside of here, there is nothing on a 4-hour chart. When price comes back into it, This is an example where in London, if you have the perfect market structure in place, you have your higher time frame target, which is this low down here, which is the 4-hour low of the previous bearish leg. You have 4-hour bearish, 15-minute time frame alignment bearish, and the first 4-hour high print, which is creating liquidity to fuel the next move. So there is both stop losses here and unfulfilled sell limits for institutional traders to come back and collect. We wait for the first retrace candle inside session, which happens to be this one here. We place a stop, minimum 10, we'll go 15 again like the previous position, 15-point stop, and we're targeting a 3-to-1 minimum risk reward ratio, which is met during the New York session or before the New York session. Again, your overall target in terms of 4-hour liquidity would be down here at these lows or even these lows, but we don't really need those home runs, those 9, 10-to-1s. Take regular 3-to-1s, guys. If you're a break-even trader or a consistently unprofitable trader right now, which is part of the process, I've been there too, just take regular 3-to-1s, 2-to-1s until you build your confidence and you build more profit in your trade journal. Then you can start to increase your risk to reward if you want to, but you don't need to. Now remember, I use liquidity as a confluence before placing my trades, but there are other confluences that I consider. I've ran through market structure, trend, and then liquidity. Now the combination of these confluences is what creates higher probability trades, and I hope that once you've watched this video twice over, that you will then have a greater and simpler understanding now on how to utilize liquidity in your own trading. Make sure you subscribe and save this video so that you can come back to it later on when you're next ready to take the trade, and I'll see you in the next video.